So you're thinking of becoming a homeowner, but you don't know where to start. Unless you've come into a large sum of money, you're going to need a mortgage. A mortgage is a loan that typically amounts to most of the value of a property or home. This allows you to enjoy the freedom of home ownership without paying the total value all at once. However, the mortgage lender, like the bank, somewhat owns the property. When all the payments have been made, your mortgage is paid off and the property is yours. First things first, you need to figure out how much you can afford to spend. The best place to figure that out is through your mortgage broker. Mortgage brokers and agents take the time to go through your income and liabilities to determine what a lender would be willing to lend you. You now have a starting point to go shopping for your dream home. Once you've got your heart set on a place, revisit your mortgage broker to discuss your options. Let's take 2 minutes to better understand mortgages. Mortgages work like any other major loan. A portion of the payment you make go toward the interest and a portion toward the principal. First, there's the down payment. This is the amount you have saved that will make up the difference between the total purchase price and how much you need to borrow to make up the rest. If your down payment adds up to less than 20% of the total purchase price, this is considered a high-ratio mortgage, and mortgage default insurance is required. There are many different types and options when it comes to choosing your mortgage. Discuss this with your agent in order to know what will work best for you. Here is some terminology you will need to keep in mind. The mortgage term. The term is the length of time you will be locked into the options you have chosen. The amortization. The amortization is the full length of time you will borrow from your lender. At the moment, high-ratio mortgages can lend for a maximum of 25 years. If you consistently choose 5-year terms, you will have had 5-year terms before the end of your amortization. There are various types of mortgages. Let's take a look at the main two, fixed rate and variable rate. With a fixed rate mortgage, your interest rate stays the same. You will pay the same amount every month, and the amount that goes towards your principal is outlined in your agreement. With a variable rate mortgage, your payment fluctuates with the rise and fall of the prime rate. However, if you choose to pay the same amount month after month and the interest rate is low, more money will go toward the principal. There are also options to choose from, such as open, closed, and convertible mortgages. Open mortgages allow you to make large payments on the loan without penalty. Closed mortgages also allow you to make a lump sum payment, but only within the guidelines provided by the lender. With a convertible mortgage, you can change between open and closed mortgages without penalty, but there are restrictions with this option. Your mortgage broker will help you read the fine print. Don't forget to ensure you have the proper life and disability insurance to protect your mortgage from unforeseen circumstances. Now that you have some basic information regarding a mortgage, happy house hunting.